What's going on, everybody? I am out here in Las Vegas attending the National Multifamily Housing Council's annual meeting. All the biggest players in the multifamily industry are all here, from the biggest owners in the country, the top brokers, lenders, service providers. Everybody is here attending this meeting. So we're breaking down what's everybody talking about, because everyone's trying to figure out where we're going, where we've been, what actions we need to take, and what we need to be looking for. So I'm going to be reporting what we're hearing live on the ground today here in Las Vegas, but also we've got great reports. Mark Zamilichap has a new report out. Apartment List is going to give us some fresh data that we're going to be discussing. And then Matt and I are also going to get into this this paper that the White House put out addressing the new actions to protect renters and promote rental affordability. So if you're a multifamily investor, whether you're active, passive, just curious, getting into the industry, been in the industry for decades, this is the show for you. We're breaking down all the data, articles, all that information that's going to give you an edge in the market to help you make some really good decisions. So strap in. So we're going to be talking about the multifamily, about real estate, the macro economy. Matt's got a lot of good stuff for us, guys. All right, let's go. Let's get into it. All right, everybody, bringing it back. Matt, this is an exciting episode. I'm looking forward to it. Got some interesting reports. I'm out here in Las Vegas, seeing what's going on. How are you doing back in Indianapolis? How's the office doing?
Pretty good. It's humming along. It's a little quieter. You brought a the loudest people. Maybe, I don't know. It seems empty here. Maybe not the loudest. If
I
I'm
was going to
still
say,
here.
I don't know. I've got a handful of people that, maybe including yourself, but
yeah, that's what I was going to say. Yeah, I'm still here. So
but we don't have. There's Addison's towering presence is not me.
Yeah, that's right. That's right.
Is there like discrimination? Is there any HR issues talking about his height?
No, I don't think so.
He's okay with it.
That's not a. Yeah, I don't think that's a class.
We had him sign consent.
Yeah, that's right. I was reading all these reports and I was thinking in the back of my head, like, a lot of the stuff I'm reading is probably not as valuable as the stuff that's going to be happening at the NMHC, but there's still enough going on, especially with that White House thing, and we're starting to get some new reports about 2023 apartment market performance. So those are going to trickle in, and you'll start to see a little bit of a trend, and maybe, just maybe, a picture of what's going to happen in 2023. But there's still so much up in the air, and that's why we're here.
Yeah, there is a lot up in the air, Matt, and I would say one takeaway is that so far from Vegas, and we're going to get into more of the details, but one thing that I've noticed is I'm a little skeptical of anyone who knows what's going to happen, or says they have a very good idea of what's going to happen. I think every conversation is basically, framed with it's going to be an interesting year, and, not sure how it's going to go. But another consistent piece is that, people are still in the market, and I'm actually, hearing of some folks that were like truly pencils down, not doing any deals, maybe in the fourth quarter of 2022, just at the beginning of this year. They're starting to get, I think, a little bit restless and are starting to look for deals. We have to remind ourselves that, a lot of these firms, their revenues, a lot of their profits, at least in the short term, to keep their ongoing operations, they're generated by, deal fees, acquisition fees. And a lot of these firms, won't be able to keep the lights on if they don't do deals. And so that's not every group. And it's actually, like, at Great Capital, we identified that as, a potential misalignment of interest between us and our investors. And, so we've set some goals and prioritized being completely profitable, corporate operations being 100% profitable, just based on recurring revenues, rather than needing to get another deal to get a deal fee. Because again, like that can be a dangerous recipe for just doing a deal to get a fee. And it might not be a great deal, and LPs may not be able to kind of read through the lines, and see what's going on. So, but because of that incentive, I'm hearing a lot of groups that are definitely looking to make acquisitions this year. I haven't run into a lot of groups that says, no, we're not going to buy anything this year. But what we've been talking about, Matt, about the bid-ask spread between buyers and sellers, it's still a little bit too wide. people are coming up to us because they know that we've been very active in the acquisition space. They're familiar with the Gray Report. They know that we're covering this. So honestly, a lot of people have been coming up to me and then just the team to get our insights.
Hmm.
And and one of the biggest questions that I'm being asked is, what kind of cap rates are you seeing right now on acquisitions? Are they, where have they risen to, and are they getting into a range where you can start doing deals? And so I can just first tell you, I didn't have to go to Las Vegas to necessarily, figure this out, but answer, if you were in Vegas and you were coming to, whether it's us or another group that's buying, trying to buy thousands of units and has bought thousands of units, I could say we're not there yet on the bid ask spread, at least on marketed deals.
Hmm.
The only opportunities that we're finding that are attractive are being brought to us, directly from the ownership of the property, and they're really involving loan assumptions, and still at good bases, but we're having to get creative to get the deals done. We're just not seeing a lot of marketed properties at cap rates that and prices that make sense. And there's a little bit of manipulation in some cases of brokers know that they know that buyers want to see higher cap rates in the fives, closer to six rather than the
Hmm.
fours. No one really has the appetite to do a four cap deal these right now. Unless it's in a incredible location, you've got some very patient capital. It's a very unpalatable experience right now for folks, and investors don't want to
Yeah.
buy low cap rates either. But what's been going on is, a broker may say, hey, I've got a 5 cap deal for you. It's a 5.5 cap, maybe even 6 cap. But what is that cap rate based on? Because you
Hmm.
can look at cap rates in
Yeah.
different ways. Is it on your trailing 12-month financial statement? Is it on your trailing 3-month financial statement? Or is it on the broker's pro forma of, in a year from now, what the broker is projecting performance to be? It could be operating at a 5 cap or a 5.5 cap, which
And
is way different.
maybe they can assume that oil was found on the property.
Exactly. Like, well, it basically, hey, ignore the past year. Everything's going to turn around. It's going to be awesome.
Yeah.
You're going to strike oil. The other
Yeah.
income line item is going to increase by $500,000, and
Yeah.
yeah, and then it'll be a 6 cap. And they're sending an email out or telling you, hey, we got to deal with a 6 cap, but is it really a
Hmm.
6 cap? And what the brokers have been doing in 2021 and 2022, which was not unreasonable because it was accurate, is that they were selling deals. They were trying to sell deals on pro forma then as well, but they were
Hmm.
looking at prices based on the last 3 months of activity, not the last year, because we had so much rent growth
Yeah.
that like, well, taking the financials and rent roll from January, versus in August, September, at the end of the year, we've increased rents by $250. So it's not an accurate representation of the property's performance when, let's say our gross potential rent was $500,000, but now it's 750. The blend of that may fall in the middle, but like, let's take the most recent activity. So now that's
Yeah.
going the
Yeah.
opposite direction. It's cutting the other way, because now a
Hmm.
broker now your last 3 months, your T3, your last 3 months of financials may actually look like a lot worse than your financials from the beginning of 2022. And
Hmm.
so I think brokers, and they're going to be using the pro forma, valuations, or they're going to be going back to T12s
Yeah.
instead of T3s. And then it's going to be the buyers who are going to be saying, no, but look at it on a T3 basis.
Yeah.
Your occupancy has dropped by 200 basis points. Your rents have actually decreased by $50 on average. Your expenses have actually gone up. You've had NOI decline, net operating income go down over the last 3-6 months. So I'm not going to take half the financial year where you had higher numbers and elevated net operating income, based my purchase price off of that, when we're in a period of still uncertainty. So
Yeah.
it's interesting conversations for
It's
sure.
really hard to imagine I mean, just from what you're painting, so I was hoping that finally the logjam would be would be get cleared out, and NMHC would have some reasonable discussion, would all get clear on the same page. But I was thinking about that. I was writing. I have notes about the single family market, and it's almost like there has to be a crisis. Like whether it's an individual home buyer has to reach a crisis,
Hmm.
or like there has to, or what eventually clears out this pricing gap is going to be people are in dire financial straits, or at least they're facing some real hardships. And I think we'll see some bad headlines associated with this as the bid ask price comes down. It's not going to be sunny, really great. It's not going to be good news that we will read maybe once we hear this thing settle out. I don't know.
Yeah, yeah, and I think that's a really good point. That I think that there's going to be a lot of headlines that are going to be like very negative. I
Yeah.
think the reality though is that yeah, there's going to be some folks in the market that are going to be in a bad spot. But it's not necessarily going to be systemic to the market itself. At least I don't believe right now. And one of the reasons for that, and we talked about this a little bit last week, and I remember I talked in some of our recent interviews talking about one, the banks are most likely going to be working with a lot of these
Hmm.
borrowers, and now that's very dependent on your relationship with your lender, and if you're actually communicating with your lender. I think 99 times out of 100, if you are transparent and communicate with your lender, they will work with you. And so, like, let's say that you're on a bridge loan that's coming due, and you really need some extra time. You don't have an extension. It's not your if you try to refinance it, it's you're going to have to bring capital to the table
Hmm.
to actually just roll it to keep it rolling. Um, you're going to have some conversations with some banks, and banks are going to be okay with saying, okay, yeah, we can give you a 6 month extension or a 1 year extension, and there may be some requirements behind that. They may have to bring some cash to the table. They may have to put something in escrow. They may put some requirements, new covenants on the loan, because of that. But I think as a whole, they're going to be working. But then the other piece is there's a lot of rescue capital that's already out
Hmm.
there, and is in some cases being deployed or ready to be deployed, and that's going to be in the case where that they have to do that refinance, but they have to bring cash to the table, but they don't want to go back to their original investor base necessarily and do a capital call. They
Yeah.
could, but maybe that investor base doesn't want to make the capital call, or it's an amount that it's unlikely they'd be able to achieve that. And so to bring in bring in some fresh equity, whether it's in the form of preferred equity or new common equity, but they're going to be getting at a reduced basis, and really can be buying some of those positions, buying in at a discount, and
Hmm.
not few pennies on the dollar, but certainly maybe 75 cents on the dollar, maybe
Yeah.
maybe even 60 cents on a dollar. And so that type of opportunity to get that type of basis in an asset class that a lot of investors still believe in, and
Hmm.
really the fundamentals are really strong. But people are just in a pinch because how they finance some of these assets. But because of those two factors of the banks being willing to work and all this rescue capital that is seemingly ready to go and on the sidelines to get ready to get injected, I don't see any systemic risks. But it's going to be very turbulent, and it's going to be a little bloody,
Hmm.
and there's some people that are going to get hurt and burned. I think it's going to be a little bit of culling of the herd in many
Yeah.
cases. I think there's going to be some operators that have been swimming naked that are going to get exposed pretty quickly here. And it's
Hmm.
going to be, we were talking with a big partner of ours yesterday, and they're an LP, institutional investor, and I think this is going to be one of the best opportunities we've seen in the last decade.
Yeah.
So it's exciting, but it's taking a very constant vigilance of where the market's going, making sure you're prepared. So
Yeah, and a lot of the and I'd be curious to know what an MHC, the people that you've been talking to, what they think about the economy this year, because a lot of the projections are hinging on, this questionable recession. Where are we? And it's funny, I was listening to a podcast on the way over here, the New York Times, the Daily. They were giving the exact same talk that we've given about the economy, in 2-3 weeks past. It's like we don't know where we're at. The employment situation is okay. Tech layoffs do not characterize the market. The inflation is primarily affecting the housing market. Like all these beats that we've
I think we're all repeating each other, to be honest, because nobody
Mhm.
really knows. And
Well,
it's yeah. Sorry, go ahead, Matt.
no, I'm very curious to see what the general sentiment is. It this same sentiment that we've been talking about, this kind of protracted uncertainty, or are people thinking, oh no, there's definitely going to be a recession, or are they thinking, no, actually, I think it's going to be okay?
I would say the mood here in general, kind of a general consensus of mood, is that we're not facing a major economic calamity, but at the end of the day, no one really knows. I would say that the mood is more enthusiastic than
Mhm.
dire,
Okay.
but very inquisitive. I mean,
Yeah.
everyone is talking about like I don't know, we don't know, but I don't hear necessarily a lot of like things are horrible, we're going into recession immediately. But it's more of like, hey, who knows what this year is going to bring? Like,
Hmm.
but we're kind of sticking to our plan. We love the asset class. We love multifamily, and yeah, there could be a recession. But we're going to deal with it as it comes. And I don't know. There maybe we're just getting to some fatigue, honestly, of
Hmm.
just economic uncertainty. And
Yeah.
I do think we've got a Fed rate decision, Matt, I think coming out today.
Hmm.
Um, and I really do think that as the rate increases, and I think that it's projected to be another 25 basis points. But that's half of what how they were raising, and it seems to be, at least consensus is telling us, um, talking heads are telling us that we're going to see the Fed soon just hold rates higher to where they are.
Yeah.
And even though that those higher rates are much higher than a lot of people want them to be, but that will give the certainty for people to actually do deals,
Yep.
because they'll believe that, okay, we're gonna get a deal done because at least I have a good idea, at least a range of what my interest rate is going to be. I
Yeah.
mean, I've seen deals, and I'm in some deals as an LP of where the rate started at 4% and we're paying 8% now. I mean, I think they refied that down, uh, but that's a huge swing, and your projections are completely messed up and off if that was the case. And it's the case with many. And so,
Yeah.
but if you can say no, it's going to be I'm going to pay a 5% interest rate or 6% interest rate. I think interest rates can probably be in the 5% range.
Hmm.
Is my gut. But if cap rates appropriately adjust and you're buying, and people have been doing deals for decades
Yeah.
before at
Yeah.
5% and higher. And so
Hmm.
also the cap rates are going to need to be, certainly north of five. Maybe in this, probably think, this, I think we're going to see a lot in the 5 to 6.5 range.
Okay.
Maybe some distress, maybe not just distress stuff, maybe in the 8% range. You might be able to buy some C class deals for in the 7 cap range.
Hmm.
Um, we were buying deals for 7 caps 3 years ago. So
Yeah.
it's
Yeah.
not like it's like incredible. And that was a period when the market was considered to be pretty hot also.
Yeah. Yeah.
So, and again, common thing we talk about every week, Matt, or we have been talking about every week, is that there's this sense of return to normalcy, and there's a lot of periods of time, whether it's a couple of years ago or a decade ago, where it's like, yeah, it looks different from 2021 and 2022, but like we all remember the shit show that 2020 through 22 were, the good, the bad, the ugly, and the horrible. And um, it's not going to be like that, and that's
Yeah.
okay.
Hmm.
Let's just kind of get ready for the just kind of normal economic conditions. But we still have to flush out some of this that we're still dealing with.
Yeah, I agree, and I think again, like it's not gonna. There's gonna be some pain that people feel. This will be there will be some failure
Mhm.
as people emerge, and it's not going to be like a voluntary thing that they're that they're going to bring these properties to the market.
No, and it's starting. I mean, the majority of like short-term loans coming due to maturity, it, we haven't really started to see it yet. It's going to be
Yeah.
closer to the end of this year and then into 2024. If you actually, look at, if you actually look up the loans that are outstanding that you can look up publicly, and when you think about that, makes sense. I mean, no one was closing deals in the first half of 2020 because there was a global pandemic going on and there were stop work orders. You couldn't physically go to the building. You couldn't inspect
Hmm.
it. Like you couldn't go there. You couldn't close. Things were on hold. And
Yeah.
so closings didn't really happen until the fall or the winter. I mean, if you look at the transaction volume for 2020, December, I mean, it was like low, I mean, like record low transaction
Hmm.
volume. And then November and then really December, just this huge rush of deal volume. And then beginning of 21, huge deal volume, and throughout 21, huge deal volume. In 2022, the first quarter or two, then it just stopped. And so
Yeah.
you've got all these deals that started basically at the end of 22. That most of these bridge loans are 2-year terms. So
Mm.
and end of 23 and end of 23 is when they're going to start. Through the end of 24. Um, but there's people that are having to figure it out, that are thinking now, like, I've got to figure this out and I've got to
Yeah.
figure it out now rather than wait for the end of the year. I mean, time flies, and even though
That's a really good point.
we're just in February, but I'm
There
looking
may
10
be
months.
there may be people that are smart, that are thinking ahead and are willing to take a haircut right now rather than really, go bald
Yeah,
later in the year.
yeah, it's true. So yeah, it's gonna be a wild time, and people really just seem like they're strapping in, they're ready to
Hmm.
go. But I don't see fear out there, and I don't know. It may just, the people who, maybe there's people are hiding it, or it's not a big deal, or it's like, yeah, we've got one deal that's a bridge loan on it, but the majority of ours aren't. Maybe they've got the money ready to go to inject into the deals, but I'm not getting a sense. I'm not getting a sense of fear. Last year, it was more of a sense of like exuberance and like just
Hmm.
like, hey, everyone's making money, everything's great, and like, yeah, it's gonna last forever, but like, hey, like, make hay while the sun shines. This year is more of like, hey, do you know what's going on? Because I don't know. Does anybody know what's going
Yeah.
on?
Yeah.
But they're like, hey, we're gonna keep doing our thing and trying to be smart about it and be conservative and not get over our skis. And we'd like to do deals, but they've got to be right, and we're waiting for the deals to be right.
Hmm. Yeah, this is going to be. I thought maybe that there'd be some stability, and it looks like we're going to have a pretty volatile, maybe
So,
another
yeah, it's like stability maybe from
transition.
one side from interest rate certainty,
Yeah.
but then instability from loan maturities coming due, and some people. There will be people who are foreclosed upon and get the keys taken away. Like
Yeah.
there are people who are going to default on their debt. Like, and I think it's already happened in some cases.
Yeah, and
Um,
I think what's keep buoying people's attitudes though is what you said, like the fundamentals are still strong. There's no underlying real, aside from the all important economic conditions, but like there's nothing that would indicate that multifamily, from either an investor demand side, I think, or from a renter side, that it's really going to collapse in
yeah.
on itself.
Yeah, I asked about investor criteria and investor interest, and I was talking to an equity broker who does a lot of JV deals and pref deals, and I just asked him about hey, has seen investors' criteria change? What are investors looking for? And he's like, it's the same stuff, same things. In fact, it's amazing how it doesn't move, especially
Yeah.
relative to rec returns. But we've been talking about that for the last 5 years of how as cap rates compressed, cash flows, are reduced, and the return profile shifts from being focused on income to appreciation. But investors are still, regardless of prices going up, they're still expecting, you know, uh, they've been they're expecting 8% cash on cash for the
Yeah.
longest time.
Yeah.
It's like, I want to see 8% cash on cash year one, and then I want to grow to 10% by year three, and
Yeah.
and it's like, that's great, and they're like, I want to see the I want to see my 8% preferred return.
Mhm.
But in a certain sense, the market can will that into an existence. But just because an investor expects a certain return doesn't necessarily mean that it's feasible in that moment in time.
Yeah.
If you want, because some people want to get into the space, some people want to get into the industry, and someone out there, many are willing to take a 7% cash on cash return. And then there's people willing to take a 6 and a 5,
Yeah.
and a 4 and a 3. And then there's someone who doesn't need any cash flow. They've got money, they want to park it, and so that's what pushes prices up. But investors, their expectations are a little bit more sticky in terms of what they
Yeah, that's interesting.
what they should think, and they haven't moved around at all.
Yeah.
Because I was telling Jay and the team, it's like 6 has kind of been the new 8 for a while. Of like, hey, like we probably like 8% year one, like that's going, like, is that possible? Like it is, but it's been very tough the last couple of years, and it's still tough right now. And I don't know if we're going to be there, immediately. I would love for that to be the case. I think it's a possibility, but we're more in a, like, at least like right now, we're more in the 6% cash on cash. In the Midwest and secondary market, B class, value added to core plus, the stuff that we do. We can make 6% happen year one, but 8's going to be tough because we're still in a 5-ish cap rate environment. We're not in the 7 cap rate environment. If we were in a 7 cap rate environment, we could probably make even mid 6s. We could make that work. Now you can put anything on a piece of paper, an Excel spreadsheet. We can magically make 8% appear on a pro forma, but that kind of defeats the purpose of trying to project things and not just write things on paper. Some people do.
Well, I think it is not to segue too hard into the first article, but I do think that there are a lot of promising things about this environment. But even yes, I did say that the fundamentals were okay, but it's not a clear shot when it comes to housing. And if you forgive me, I'll just jump right into this first housing research brief.
Yeah, let's do it.
So Marcus and Millichap have a short housing research brief, as well as a longer 2023 U.S. multifamily investment forecast. And I'm going to start with their housing brief to kind of give a little context. As much as I was hoping, again, for signs of life in the housing market, things are such that demand is muffled, which that's what they note in the headline. And there is, I think, some slack in household formation. Regular viewers and listeners to the Gray Report will remember a report that we covered 2 weeks ago from the Harvard Joint Center for Housing Studies. And that report looked into the surge of household formation during the pandemic, with the implication that this housing demand could decrease going forward. I think that the sluggish December housing numbers are not a huge indicator that we're going to see sustained lower household formation, but we may just have a set of conditions that will get us there anyways. And I don't think that it is a worrisome sign, but it is more like a quirk of the market, in the same kind of factors that you talk about, where people are sitting out the market right now. They don't want to sell because the numbers are too small, but then buyers don't want to buy because the numbers are too big. It's happening for slightly different reasons, I think, in the single family market. And this research brief does wonder aloud why employment gains are not translating into more household formation. And it notes that a multifamily rebound may be comparatively easier, but it again returns to the idea that economic conditions and cost of living concerns are directly impacting rental decisions. It's hanging a lot on the economy, but as I'll kind of try to explain here, I think that a lot is due to the interest rate situation. Again, totally agree that this housing demand driven by the economy largely. But what I said before, I think we've got this clashing set of factors that have slowed down the housing market in a way that's every bit as real as if it were pressured forward through low employment. Typically, I would think of lower household formation being caused by situations driven by personal economic hardship, like you lost your job, have to move with your parents or something. But if employment is doing fine, then what's the factor? Well, I think it's this elevated inflation and high interest rates. Buyers still don't want to buy a home at these prices and these mortgage rates. And so whichever way you slice it, sellers don't want to sell a home just to have to pay high interest rates that are so much higher than they were at the beginning of last year. As Marcus and Millichap's John Chang explains in a separate video published this week, the economy is humming along, and high-profile tech layoffs don't necessarily characterize what's otherwise a very healthy job market. So while economic forces are clearly a factor for lower household formation, I don't think we're in a we're not in a low employment official recession. And I really do think that slack is the right word here. The market's not as tight as it needs to be for prices to move. And like that Harvard Joint Center for Housing Studies report, we're snapping back and maybe winding down a little bit from the tight markets that we had in 2021 and 2022. Just treating household formation as a thing in itself doesn't explain this completely. And I think that the majority of this slack is, again, the result of higher interest rates, making it so that home buyers have to pay a higher monthly mortgage payment for the same sticker price. One way we'll get to a tighter market is for home prices to come down. Same thing with the apartment market. Those prices got to come down for things to tighten up. But it's tough when there's not a lot of homes on the market. And there are a lot of housing experts that are expecting further home price declines. I think it's going to be a long time coming because we're waiting for this critical mass of homeowners to either through psychology, they've got like an emotional breakthrough, or through necessity, they've got to move or something, get a different job or whatever. They've got to accept reality, accept the changed housing environment, and bring more single-family housing stock into the market. There's got to be that like crisis or real transition, because I don't think there's anything inherently in the market that's motivating people. If anything, there's a lot of reasons not to jump into a decision like this willy-nilly.
Yeah, Matt, I think it's interesting, point that you brought up, and really kind of breaking down the people who have to move, like you said, like they've got a job, like they have to move, they have to do something, but maybe they've like held back. It's like that's going to happen at some point, but just like maybe delayed that. And then there's the people who like there's maybe no sense of urgency, but like they at some point, maybe statistically, historically, will move out. And just one of the facts on the Marcus and Millichap piece talking about some of the pent up demand, which I think is a big that's one of the big factors of are we going to have a decent year or a bad year, is if there is enough pent up demand that gets released. And if we have a recession, I don't think that's going to happen, but if we don't have a recession, maybe it will. But they're basically quoting last year, so this number may have increased. There's more than 23 million individuals in the 18 to 34-year-old cohort that live with their parents. And that's roughly 3 million more than the long-term average. So you're always gonna have people living at home with your parents. That's totally fine for a variety of reasons. But we've got a lot more than is typical. And I can see that number have even gone up. Kids graduated from college, and they move back with their parents, and they're like, get an apartment, but then they're like, Mom, Dad, maybe I'm having a hard time getting a job right now, which should be a little hard to believe, but maybe they wanted to go into tech right now. They all said, I mean, think about it, 4 years ago, it's like, well, who wouldn't want to be going into tech, right? It seemed like the no-brainer. I want to make a couple $100,000 out of college. Now they graduated with whatever degree they've got, and in their mind, they should be they're holding out for that $300K year a job or whatever, that six-figure job right out of college. Which, I mean, when Matt, you and I graduated college, that was like, it was like post great financial crisis. I remember being like, I could make like 30 grand. I'm going to be like awesome. Like I was so excited, maybe to make 30, 35 grand, everything you need. I mean, Midwest is cheap, but I think that's expectations have changed, because there's just 10 years of like this economic boom and all this tech money, and you go to a coding boot camp for 3 months and you're making 6 figures after that. And so they're like, Mom and Dad, like, Salesforce isn't calling me back, Twitter isn't calling me back, and you know what? I'm just gonna hang out here in the basement because I don't want to, get my own thing. And their parents, are they're watching Fox Business or whatever, and reading the headlines and talking about economic calamity and recession, and all this stuff, and they're like, son, daughter, why don't you just hang tight right now until we get through this. And and then there's parents who are like, great, I want my kids to live with I want my kids to live with me forever anyway. So yeah, just stay here, stay
Mhm.
close to me so I can keep my eyes on you. But
Well,
not
and
every
I don't.
parent's like that, but
Yeah, well, yeah.
some are.
Uh, I think that there is some pent up, as much as maybe people are getting used to living with their parents, they like that situation, that's fine. But I also like to think that those decisions that were delayed for the past maybe 3 months, or maybe it's going to be 3 months going forward, whatever sluggishness in
Yeah.
terms of housing, household formation, I think that's going to be pent up. Like the slack is building now, or, we're starting to wind things back up a little bit as the more the longer, I'm sorry, we're in the situation where there are not enough single family homes in the market. And I think that it's a little bit different when it comes to apartment demand, but every time people say that it's different, like they're not really, they're only right at the margins. I think that this echoes in the apartment, when it comes to household formation, that's redounds to the benefit of the apartment. It's not all a story of millennials delaying their movement into single family homes. Like it's a
Hmm.
bigger story about housing. It's a bigger story about household formation. And I think that the largest factor, which is the economy, usually in household formation, is making it so that we're getting things pent up. We're penting it back up.
Hmm.
At least is my take.
I agree, and so I mean the demand's going to be released at some point. I mean, how much? Not sure, but
Yeah.
there's demand being pent up. I think we would all definitely acknowledge. I think that's just about a fact. Just showing there's 3 million more with the long-term average. I mean, that's just one piece of evidence right there. But the question is when. It could be as soon as the next couple of months. It could be next month.
Mhm.
End of March. End of March, April as things get warm. Um, but yeah, like you said, it's so related to the economy, and if things get really bad, and again, like worst case, relatively improbable, but potential scenarios just to use as an example. So, World War III, and I'm not mean like nuclear bombs everywhere, World War III, but like let's say the war in Ukraine gets like a little bit more serious, and
Mhm.
it's more than just a proxy war between um, NATO and Russia in the West and Russia and what, but it's an actual war between NATO and Russia, whatever. But things have escalated significantly, that would cause so much global uncertainty. People are already pessimistic. People may just throw in the towel at that point. And I could see that throwing us into a recession. And then people will talk. Again, fear is such a powerful driver, and that fear of the unknown has been leading to this, just on people not taking these actions and creating more and more pent up demand. Yeah, if there's a big war and people are talking about nuclear war or whatever worst case scenarios we want to talk about,
Mhm.
that's not getting released anytime soon. And so
Yeah.
then we're looking into 2024, whenever.
Yeah, this is going to be this will be interesting, especially since the primary driver is so uncertain, and it's weird to think of household formation in a spot that's not driven completely by like employment, and now it's driven by like buyers not wanting to put their home on the market,
Yeah, it's all
which is kind of
psychology right
economy.
now.
Yeah, yeah. So,
Um,
but
that's why business majors, I guess, take psych. One of the
yeah,
first class visits. I mean, it's all psychology and mindsets, and as we know, perception is reality, and
hmm
perception doesn't necessarily have to line up with like some of the facts on the ground.
yeah,
So we can have much different realities.
yeah, for sure. Now, just kind of move to their 2023 U.S. multifamily investment
Yeah,
forecast,
yeah.
specific
Thank you.
to the apartment market. Now, so that's the situation kind of in general with housing and a little bit single family. But moving to, yeah, what do they think about apartments? This is a really nice report. It is a fairly lengthy report with lots of information for a bunch of different individual markets, as well as like we have typically some kind of economic forecast, some investment market forecast, supply, and some national level numbers. One thing is, for the life of me, I could not find the number for their prediction of 2023 average U.S. rents. They call this the U.S. Multifamily Investment Forecast. I thought that maybe they had a rent growth prediction that was in writing. They reference that and they represent it visually on a graph, but they don't give us the number outright. I could have skipped over it, but I
Rent
really
growth?
think I was surprised a little bit that it wasn't there, and that's fine. I was able to find it. I went to the appendix. I had to scroll all the way down to
Do
this
all do all this.
paginated section of the appendix, subtract the 2022 effective monthly rate from or effective yearly rate to the 2023 effective monthly rate, and divide that number by the 2022 rate, and I've got the number. I found it. 3.12%. 3.12% as a national average. I don't think it's anything to be ashamed of. So why do they hide it? Why do they force me to scroll? I don't know.
Yeah,
Mostly
Matt.
Yeah.
When you it's interesting. When you sent me the report, and this just was released yesterday, I believe, or 2 days ago. And when you mentioned that, it's like, what do you mean they don't include that? I mean, that's like a top line KPI that, like, just, even if you can argue that it's not the best one to look at, which I think it's pretty good. I don't think anyone say that it's not important. It's certainly one that, like, is the most common metric that is reported. Is, what is the rent growth when you're making a projection for the year. Now, I guess I could understand if they're like, no, this is market by market. We're not doing national outlooks. We're just looking at market by market. Because real estate's, local, it's all about your local market. But there's all kinds of national figures in this report, though. I mean, some really great stuff. I mean, whether it's like the national affordability gap, and tracking that since 2000, and looking at the affordability gap of mortgage payments and average effective rent, or maybe it's there's all kinds of national reporting. I mean, employment trends, supply and demand on a national level. So why don't you think that they included national?
I don't know.
Rent?
The only thing I could think of is that maybe they are scared of people just skimming over that headline number. Maybe it was an oversight. I don't know. Like just a little info box would have been helpful. But yeah, to your point, like, I think it is an important. Maybe it's a general number that, like, it's not really existing. It's an average, and this is an abstract concept, but it does help to characterize the report. It helps me to frame my expectations as to what their high end is going to be and what their low end is going to be. Without that average to kind of get my bearings, it makes it a little bit more difficult to dive into the report. But luckily, I was able to do that math, got the 3.112%. Again, nothing to be ashamed of. Not really sure.
Nothing to be ashamed of. No, it's true. It's true. But there's a lot of good. So we'll dig Marcus and Millichap for not having a number. Maybe it is hidden here somewhere. Maybe they're like, hey, look, this is a year of uncertainty. Like we don't know. We can give you some ideas on markets. But to your point, a footnote or an explanation would have been appreciated. But as usual, Marcus and Millichap does present a really great report. And you can find this, if you're a subscriber of the Gray Report, the newsletter, you go to graycapitalllc.com/newsletter, or you can go to grayreport.com, or also you're subscribed to the YouTube channel. You can get this stuff, sent to your inbox. And but it's a really nice report. Obviously, we don't have time to break into every market, but Matt, any other highlights that you wanted to know?
One surprise was that some of the Sunbelt markets that have been in a precarious position, for Marcus and Millichap, they're actually looking pretty good in 2023, according to their projections. These same markets that were at or near the top of the list of, like, vulnerable markets, some of them are really at the top of these promising markets for Marcus and Millichap. I'm specifically. Austin is one that they're really thinking is going to do really well. Now, I know that Austin's got a lot of supply coming into online, but they're thinking that it's really going to be maybe one of the strongest, if not the strongest market
Really?
in the nation. Now, they have it ranked number 6, but when it comes to the markets, we're seeing a lot of the Sun Belt. Fort Lauderdale's number 1, followed by Dallas, Fort Worth, Orlando, Miami, which that's the one that is like the outlier. I always thought is like, this is a Sunbelt market that no one is skeptical of.
Yeah.
But other markets like Austin or Tampa, St. Petersburg, maybe even Atlanta, or like Charlotte was another one where sometimes people are a little worried. And Phoenix is coming in at number 11 after a really troubled 2022. So maybe the Phoenix will rise from its ashes. But this is definitely a outlier, or this is a different projection that we've gotten from other ones that were predicting maybe more of a muted growth among the Sun Belt.
It's interesting. I've heard so many different opinions, Matt, and I'm so glad that you brought this up and highlighted in this report, because I've heard so many different opinions about different markets in the Sun Belt.
Mm-hmm.
The few consistencies are, Phoenix is, people are worried about Phoenix, just because of just people buying at just crazy prices into just like the frenzy, and just some like direct, just anecdotes from people who like were very close to some transactions of like, I mean, I had a conversation last night with this guy, and he's like, and we sold this group this deal at a 3.2 cap, and they've got a bridge debt on it. He's like, they're screwed. Like they are screwed. Like he's like, I'm sorry for them. Like, it was great for us to sell to them. He's like, I feel bad for them, but like, rents have declined in Phoenix. They're continuing to decline. No one's buying at those caps. Like, you are so underwater. Like, you are going to have to bring millions of dollars to the table to keep this deal alive.
My in-laws were in Phoenix just last week, and they said there's more cranes. No, they said there's construction everywhere. There's more cranes than a wetlands area. It's like it is, everything's building. Trying to come up with a metaphor.
I had to put the. That was good. More cranes. Protected wetlands. That's good. I haven't heard that.
But yeah, like they're still building there, and so as much as and we've said this before, as much as 2022 was like Phoenix is dealing with this influx of new supply, there's still more to come.
Yeah. To me, it's so fascinating because I even just talking to experts, as soon as last year, people saying that Phoenix has kind of graduated out of its boom and bust cycle, and it's going to be just more of a strong growth, almost mimicking acting more like Dallas, which is strong growth, but just a little bit more consistent and robust and a little bit more stable. But I'm hearing different opinions on Dallas. I'm hearing some people say like, no, Dallas is good. I mean, like folks like talking to Carl Whitaker, he's like, no, Dallas is like very well positioned, and I think Dallas is going to be well positioned. But then I'll talk to someone else like, no, Dallas is like, it's just way too much. There's been too much supply coming online. I'm of the opinion that Dallas, if any market can absorb that type of supply, I think Dallas could. But I just hearing these different opinions, and so there's really not there's some consensus on some markets. Like Charlotte, I've heard people say that Charlotte's gonna be rough in Charlotte, or Charlotte's very well positioned. It literally, and we've noted this on different lists. You have some markets being at the top of like markets to outperform in 2023, and then on someone else's report, they're on the bottom. The markets to watch, markets at risk.
I'm going to spend some time this week and next week, and I'll it'll be nice to measure these against each other.
Yeah, we should. That'll be good. So it's that's why I think the more than ever now is a time to discount some of these predictions and outlooks, because again, just like we started the show, Matt, people don't know, but there's a huge demand for answers and certainty. And these groups that are regularly put out reports, and we're a part of that ecosystem. We're disseminating and listening to us just ramble, but people look at Marcus and Milchat and be like, "Hey, where's your annual report? Give us your prediction. Where's your national annual rent growth prediction? I need it." And they're like, "We don't know." And they're like, "Give us a number." We're demanding a number regardless of whether they have one or not.
Yeah. It's like they mumble it. It's 3.1. What was that? 3.12?
And just be like, oh, good, I'll put that in my models. No. Like we don't know.
Yeah. I do, but I think you were right. People are unsure. And what's interesting is like there was kind of a little bit of a narrative, like, oh, people coming back to the workplace. Maybe the Sun Belt's not as strong. But and then early in the pandemic, the Sun Belt, people were remote working and going, I don't know what the story is for this year. This faith, the renewed faith in Sun Belts, or at least the select Sun Belts, is maybe one of the more interesting things because it does diverge a little bit from the trend from the last 6 months. So I'll keep my finger. I'll look for a story and I'll we'll be forming one, I'm sure, as we go to make sense of this.
Yeah.
But
Absolutely.
the upshot to this report, if I could sum it up, is I think that they are bullish on the Sun Belt. They see 3.12% rent growth on average, and they have some really great detailed projections for individual markets in this report. I may have mentioned it in passing. They also expect 400,000 apartments coming online on the national level. Again, that's a market by market thing, but that is their supply projections as well.
And that's relatively consistent what we've seen. I think some other numbers been like 440,000, but I haven't seen many predictions below 400,000, but I haven't seen a whole lot above 500,000.
That definitely seems within the wheelhouse of
yeah. Well, again, hop on over to grayreport.com or sign up for the newsletter for the Gray Report, graycapitalllc.com/Gray Report. You can get like reports like this Marcus Millichap brief, all kinds of other stuff. Just sent to your inbox every Thursday. Again, it's really not much fluff. It's like, bam, here's like 15 pieces or 20 or 30 of like you should be aware of and forward this to your team so they know what's going on in the market. It's not a lot of fluff. We may like have may have a button to be like, hey, talk to us. Click here if you want to talk to us. We've got a fund. Credit investors only, but this is about the meat and potatoes of the issues. So, Matt, are we ready to move on? You want to move on to this
moving to the White House
sheet, or do you want to stick to markets and pop over to apartment list real quick and then round things out with government?
Let's speed through. Let's speed through this apartment list because this is just really quick. I just wanted to note this because this is the first of the monthly rent reports this year, which comes from apartment lists. They usually have it a little early. It does look like things are getting a little bit clearer when it comes to rent growth. It's not instantly great news, but it looks like we may be seeing some light at the end of the tunnel here. And this is particularly notable because apartment list was on the more extreme side when it came to the rent declines that we were tracking throughout the end of 2022. And national rent growth is still negative. It's when it comes to month over month, it's negative 0.3, and it is at 3.3% year over year, which 3.3, well within the normal range. But as you can see in the apartment list's graph, the rate of this negative growth is shrinking. And if it continues on this path, maybe a little less, maybe we start getting more. Maybe we start getting positive growth entering into renter season later this spring. And then just to kind of continue speeding along for the top markets that they have in the apartment list, Indianapolis leads for the year and also for the last 6 months. And the other 6 months leaders are Miami, Oklahoma City, St. Louis, Houston, Memphis, Tucson, Minneapolis, Milwaukee, and Cincinnati. Lots of Midwestern markets there. It's funny. Memphis is a little bit of a state that I've heard that it may not be doing so well in 2023. But again, this is another variation that I'm going to sort this out.
I don't think it's going to be an analog or it's going to be the same thing. But I mean, with some of the, like the horrible video that came out of Memphis, like last week or so of, those police officers murdering that guy. Looking at what happened to Minneapolis after a sort of similar incident. I don't think it's the same. I think Minneapolis had other challenges, and obviously we're not seeing. I think there was potential for a major civil unrest, but I don't see people thinking Memphis is like so unsafe, so that I'm not going to live there or invest there.
I wonder.
You always have those concerns, but I don't think that's the case.
Yeah, I think that when it comes, it's like I don't know what these like kind of news social movements are going to result in the apartment market. But I do think that the apartment list, their individual market information is a lot different than other ones. There is a subtle grouping. It's a subtle pattern. Usually they're similar. There's some huge variation here and there, but I remember that apartment list has a little bit different take on individual market performance than a lot of the other reports.
Yeah, it's a little bit more. It's a little bit more volatile. A little bit more swings, which maybe it's maybe a little higher frequency and it's getting good data, but yeah, you always have to wonder.
Yeah.
Just one other.
Yeah.
I mean, look at Indianapolis, Matt. I mean, 6 months, 12 months, and since 2020, I mean, taking the number one spot this 6 months, 12 months, and then top 10. It's at 10. But since 2020, because I think the argument is going to say it's like, yeah, well, Indianapolis is down here, and then everything else goes down, it rises. But it's even going over a not a long period, last 3 years, but in a period of a lot of growth. So if we didn't have a lot of like growth, if it's like when things are growing, but like Indianapolis doesn't grow a whole lot, but just when things decline, we kind of keep growing. We wouldn't show up in the top 10. But you get the stability and resilience of when there's declines. We don't see really major declines. Sometimes it's just flat where everything else goes down, but then we also experience part of the upside as well. So I think it's a really, again, like I'm completely biased because I'm from Indianapolis, live in Indianapolis, invest in Indianapolis, trying to buy more in Indianapolis, and obviously trying to convince everyone watching this to invest with us, to invest in Indianapolis if you're a credit investor. But I mean, here it is. I mean,
the long story and the short story are pretty much in our favor. And it is interesting. Over the past 12 months, 6 of the 10 are in the Midwest. So if you're looking at stories, the steadiness of the Midwest has remained a kind of underlying story. The story's changed when it comes to the Sun Belt. Never really quite changed so much when it comes to the Midwest. Maybe they just don't like change, but whatever. The slowest growth markets are led by Providence, then it's Seattle, Rochester, Grand Rapids, New Orleans, San Jose, Detroit, Boston, Las Vegas, and New York. It's really a big mix, actually. And the difference between the 6 and 12 months for the slowest growing markets could indicate some interesting shifts in markets. Phoenix, for example, has the lowest year-over-year growth, but it has done better in the past 6 months, and it's not even on the list of 10 slowest growing multifamily markets. So maybe Marcus and Millichap have they know something, and they know that Phoenix is going to rise.
Well, but so can we get into inside baseball on that though, Ben?
Yeah.
You know where John Chang's from?
Oh yeah, that's true. Okay, so we're pumping up Indianapolis. Well, maybe John Chang. He's got a rep for your own.
John Chang is a super brilliant guy that I have like a ton of respect for. But like, I've had personal conversations with him about Phoenix, and he loves Phoenix, and he thinks it's got great prospects. And he was one of the people that were telling me that he's like, Phoenix has outgrown that boom and bust cycle, and just like I am biased again towards Indy and maybe have a little bit of a blind spot, and I almost try to like discount it because I'm like, oh well, maybe I'm missing something. But I'm just saying that they're, again, like I'm just saying, I think he's their head of research and puts these reports together, and he does live in Phoenix, and so I'm not saying I'm biased, like.
But that being said, like I don't, and I think we have said this too in all of our discussions about Phoenix or kind of similar markets. It's like they're not gonna go crash and burn completely. It's just going to take them longer to absorb. And I think that gets to the maturity. It's also like flat out population level. Like Dallas, Fort Worth can absorb millions, where something like Phoenix maybe can only absorb hundreds of thousands. There's a degree of difference here that I think plays a lot into the maturity of a market and maybe a little bit of its employment situation, but sometimes just population.
And then we don't need to get into too much into Phoenix, but I mean it's a really cool market. But the other thing that I have heard people say is a concern maybe about Phoenix is water and getting enough water support that type of population and the
Yeah,
industry and everything. I don't know.
I think about that on Vegas. They're in a desert. How long can you do that?
Well, and there's talk of, a lot of these lakes and reservoirs. I mean, they have been drying up.
Now, I'm not an expert. I do think it's very interesting and weird to me. Like, we've got a lot of places. Why build it?
I sometimes I think those like things that are like you have to think about because it could be a factor.
Mm-hmm.
Sometimes I'm optimistic enough though to be like, I think
it's a
they'll figure.
Well,
we'll figure
and it's a big enough thing. Like, people are thinking about this
it's
problem.
Existential. Yeah, exactly. Yeah. It's existential, and you'd like to assume or think that.
That's right. Yeah.
All right, Matt. Let's go on to this fact sheet because I'm going to have to run here in a minute. I've got another day packed full of meetings with brokers, lenders, and all kinds of fun stuff, which I can report on next week. But give us the breakdown. Yeah.
All right. So the White House made some announcements. So the White House made some announcements, made a little bit of a plan, maybe some actions, although it's arguable whether these are concrete actions and it's just the action of making an announcement. They're all kind of revolving around rental housing and fair housing. And we have a fact sheet, and there's also a White House blueprint for a renter's Bill of Rights that lays out the principles that are guiding these actions. And they have 5 of them. And I think you might like the last 3. The first 2 are safe, quality, accessible, and affordable housing. Seems fair to me. This is something, again, that we covered last year about their desire to increase the housing supply. Next is clear and fair leases. Again, that's like, it doesn't seem that much of a sticking point. But then the next 3 are so the first of these 3 is education and enforcement and enhancement of renter rights. And then following that is the right to organize. And then following that is eviction protection, diversion, and relief. As the blueprint document explains in its opening paragraph, they say that our nation's rental market is defined by a patchwork of state and local laws that renters and rental housing providers must navigate. And I noted this before, it's really like a fractal. Like, this is a patchwork on whatever level you are looking at. You're going to see a level of complexity that you're going to stare at, and there's always going to be one person down the line, maybe it's a single homeowner, that could stand in the way of increasing rental supply or solving the regulation issues or what have you. I think that those last 3 topics now, I think that there's an interesting way that I've thought of kind of characterizing these. So the first 2 topics is renters' rights and leasing. That's kind of like setting up the rules of engagement a little bit, what the rules are. But I think that the last 3 kind of deal with housing conflicts in one way or another. Mm-hmm. So this is about, establishing the rules. So how do you teach people about their rights when a conflict comes along? What about the parties that are involved in these rights, which is the right to organize? And then what is going to happen eventually when you're in the situation where maybe you want to evict someone, or maybe someone it deserves to stay? So what are the rules of engagement for these conflicts? And this is probably the 5th or 6th time I repeated this. This is very much a Band-Aid level. This is not the level of supply. We are dealing with the level of the interactions between a renter and landlords. I think there are some noteworthy parts of the White House's actions. I think this could mean some places do business differently and maybe suffer if some margins are very small. But I do think that that this is a lot of talk and not a whole lot of action. There is a left-leaning source called Jacobin, and if you Google the Biden-Harris administration rental affordability, you'll get this article, and it basically characterizes this as talk is cheap, and it says that Biden's announcement last week failed to include any immediate action. They even reference the fact, here's a quote, it says, one very interested stakeholder doesn't seem fooled by these announcements, the landlord industry. A wave of furious lobbying of the White House by the National Multifamily Housing Council, the National Apartment Association, and the National Association of Realtors has paid off, and they were not shy about saying so. So this is kind of an interesting situation.
They're raising money for the PAC at the conference.
Yeah. So I don't know. Maybe they're congratulating themselves at this conference. I don't know. But I do think that it is what I was left with is, which of these announcements, the supply side announcement that we got in 2022 that seemed to be like deregulation, let's make it easier for developers to build, or is it going to be this kind of renters side where you're talking about things that seem a lot like rent control that come down the line? I don't think that we are going to see any action very soon. Maybe along the lines, though, some of these committees to form opinions, to create recommendations, to form a study, maybe these will influence some actions in a year or two or whatever. Again, I don't. We're not going to see $100 billion program, but we may see some pilot programs, maybe some changes at the margin, and it's going to be interesting to see which side which voices are going to prevail in when it comes to the administrative difficulties or the administrative desire to put action out instead of words out.
Yeah, well, I think that's the key. This is all about appeasement, and that's it. There's nothing happening with this letter. This is 100% about appeasement.
But then,
Well, I think that if we wanted to do something to tackle, housing affordability and tackling the housing crisis, and beyond the fact that we need to ask ourselves, what role should, if any, the federal government be playing in these types of policies for real estate and private property, at a local level. Obviously, there's things that they can do, and might be a good idea, and maybe some guidelines, and maybe a letter like this is like it of saying like, hey, here's laying out what we think we should do, and then let states and local governments take the reins. But the fact that they're not drilling down on, we did not increase the caps, we did not add more funding to federal tax credits.
Where's the number?
For affordable housing. That is absolutely appalling, and it shows how incredibly disingenuous the administration and politicians in general are to addressing the actual problem. Their only solutions are in complete contrast to property rights.
Well, they just don't want to do the work. It's going to be so hard.
It will be hard to do the work.
Yeah.
I mean, creating a toothless bill of renters' rights, the federal government, there is a role for government in regulating some things, although I think they do way too much of it. I think there is a massive need for civil society, which are organizations, to create things like this in policies. And that civil society, that's what NMHC is part of. That is trying to set these guidelines, or the National Carbon Association. There are renters organizations. They say renters need a right to organize. Well, they have a right to organize, but what, property owners have a right to not rent to someone that if they're trying to organize to be disruptive to their business practice. I have no obligation to rent to all 25 of you of your group, because you put yourself in a group. Like, you do not create a protected class for yourself that you can that are beyond. Like, I can't renew your lease because you're going to try to go on a rent strike.
I will say that they did seem to qualify that as like HUD, associated with HUD properties and other maybe technically government supported federal housing. But
that's a great point. That's a great point. That's a great point. And the multifamily industry and housing industry in general, we are, have been relatively addicted and totally used to kind of some of the subsidies the federal government have been throwing out in the form of government-backed loans or government-guaranteed loans, issued through the FHA, such as, or the USDA as well, such as including Fannie Mae, Freddie Mac. HUD, these are loans that have some guarantee or backing by the federal government. They're being securitized, and then they're quasi-governmental entities. And it's only on us, as an industry, if we're going to accept that type of the partnership. I'm just going to have a partnership with the government. There are going to be some rules and regulations, and that wouldn't surprise me, and I don't think it would necessarily be inappropriate If you're going to put some new guidelines of, hey, you have
Yeah.
to have renters bill of rights, okay, drop it into your loan documents, and hey, you don't have to go get Fannie Mae finance. You don't have to get FHA financing. That's
Mhm.
one of the but again, this is one of the reasons why the FHA, or Fannie and Freddie, not FHA, but Fannie and Freddie, there was moves to be privatized and actually have more of a private market for this types of financing. Fannie and Freddie, the agencies make up well over 50% of all the financing on multifamily deals. Commercial loans and make up a chunk, and CMBS and life insurance debt makes up all very small percentages. And it's going to maybe take a shift in the industry to move away from some of this agency financing.
Mhm.
But that shift also is going to be met with those agencies needing to stay competitive, and maybe they'll
Yep.
retract some of those policies. So, I mean, they've done it in the past, similar initiatives, or such as like green initiatives for environmental reasons.
Mhm.
That was more what I would say they have done a good job at is using the carrot approach instead of
Yeah.
sticks. And I
So,
believe I think there's a
mhm.
quote specifically referring to that, related to this. It's basically, I think if it was MHC or NAA saying, "Look, we're going to get there with carrots, not sticks."
Yeah.
Incentivize people for being more environmentally conscious.
Well, and
If
that's what I was going to say is what if they just give you better rates and they're like, all right, we're giving you these better rates, but we got more rules. As long as what I'm hoping, and again, this is the government, so I'm not hoping for a lot. But if they can make a predictable rules of engagement, then of like if they're trying to streamline things, then and as long as they make the terms attractive enough, then that's fine.
Yeah,
But I
and
don't know if that's
that
gonna
is
work.
what they typically do. So like if like for like the analog is like the green rewards program.
Hmm.
Like, heck, hey, if you're able to reduce energy consumption, we're going to give you 15 or 25 basis points off your loan.
Hmm.
Or mission driven programs. So it's like, all right, if you are renting to individuals that meet our core mission of Fannie or Freddie, which means like incomes of this range, like where we really want to help serve this people, bottom
Yeah.
quartile, whatever it is. If you can qualify for mission, you can get a better rate, you get some better terms. But it's not necessarily saying, oh, you need. I mean, some lenders may put covenants into the loan of like, hey, we want to renovate these units.
Yeah.
Very rarely, because it would be incongruent with a market rate business plan, would they say, but mission program, but you have to keep rents, at 25, 30%
Hmm.
of, or 40% of AMI, or whatever it is. I mean, you do that on tax credit deals, you make those agreements. But not necessarily just on your standard agency lending. So I think some of those tools are out there. I think it can be a little bit of a slippery slope of
Yeah.
policy, federal policy, back going through these programs. But we're not necessarily as a industry. There's nothing forcing us to use these loans, this
Yeah.
type of financing. There's private financing out there, but agencies have made it attractive. And part of this to push policy forward. So I
Yeah.
think it's kind of a toothless letter from the White House. I think a lot of I still think it's mostly appeasement. I don't see a
Yeah.
lot of like real like a good actionable plans, and I think we're skirting around some of the big issues, and we need to build more affordable housing.
Yeah.
And anything else be talking about, again, like safe quality, they want safe, yes, clean,
Yeah.
fair,
Yeah.
yes, okay. What,
They did note one of them what one of the actions or some kind of reference in one of either the blueprint or this fact sheet was about sharing rental data, and I think it seemed to reference the yield star controversy, where maybe there's this kind of, I don't know, want to say monopoly on information, but
yeah,
I yeah, I think I agree, but I think that these communications from the White House do at least indicate a direction. So maybe there might be tiny changes in policy, whether it's on the local or the national level, that are influenced largely by these positions that are taken.
yeah. Well, we shall see. Again, think it's a lot of talk. I don't think much
Yeah.
action is gonna take place, but it's certainly critical to understand what the conversations are going on. Matt, unfortunately, I've got to run. I got to
That's
get back
fine.
into the thick of.
Sorry for keeping you late.
And no, it's important. You know, we haven't missed an episode since we started, so we're not going to start now. That's for sure. And these are the times and the moments in the middle of it, having these conversations directly related to the conversations we're having every week. That wanted to give you the updates and information as they come immediately. But I got to go. I'm late, Matt. This is a great
All right.
episode. Everybody, like this video. Make sure you're subscribed to the Great Capital YouTube channel. And you know what? If you are a accredited investor and interested in getting allocated in a really exciting asset class, some great opportunities that we have right now, that like we're only a handful of people here that have deals. I tell people about these deals, and they're like, "That's it." They're like, "That is incredible." So if you want to learn more about them, why we think they're awesome, why I think they're awesome, hop on over to, you can go to great.fund, if I'm in your browser, greatcapitalllc.com, shoot me an email, Matt an email, whoever, Blake an email, you guys know the crew. Appreciate it. Have a good rest of your week. See you next week on the Great Report.